All right, let's go ahead and get started. Good morning and welcome to today's Tuesday Markets Outlook webinar, the last one for the year. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the broader markets. So before we get started, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, as usual, kicking off with the major equity indices. We are seeing a continuation of the rally, especially from last week's Fed meeting. But now equities are, especially the S&P and the Nasdaq, are now just shy of all-time highs. So we most likely will be seeing new all-time highs before the end of the year. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader markets. We'll take a look at a couple of subsectors of interest that I have for you today, and in today's webinar with some bullish and bearish market observations, mostly looking at the ones that we've discussed in the last couple of weeks, but also have one new idea for you today. So the S&P 500, looking at the SPY ETF, all-time high is at 480, price at 473, set to open this morning. So clearly a lot of underlying momentum here for the S&P 500, as you can see on the daily and the weekly chart with the 50-period CCI well into the positive territory. We saw price breaking out of that 460 level on the daily time frame. And last week's Fed announcement really proved to be a bit of a catalyst to start the next bullish leg. So with the Fed announcements that we had last week, interest rates stayed level. That was largely expected. But what we did get confirmation was the Fed's clear dovish stance when it comes to interest rates for next year. We are now looking at potentially 3 interest rate cuts for 2024. Markets were only pricing in 2 interest rate cuts during this very strong rally. So that is why we have seen now a resurgence in terms of momentum for equities, especially with the risk-on type of sectors like technology and communications. And we should see a continuation here heading into the new year. So with the S&P 500, it is looking like it is approaching that overbought territory. But the one thing I will say about that is with 2021, one thing that we learned with the S&P 500 and the Nasdaq 100 especially, was that the major indices can remain overbought for a long period of time. So because of that, even though we are seeing the S&P and the Nasdaq, approaching that overbought condition, it doesn't necessarily mean to be bearish. In my opinion, my investment strategy heading into 2024 is to be looking to purchase shares outright for a longer term holding, using the limited pullbacks that we do see as good options trades. Because the mistake that I personally made in 2021 was that I was waiting for too much of a pullback, and we weren't getting that so much with the S&P and the Nasdaq. I'm not sure if you guys remember what the markets were like in 2021, but it was a very bullish environment. And I think many people were just waiting for a steeper pullback before looking forward to add long exposure. Whereas now it looks like we may get a similar year to 2021 for 2024. And again, you don't want to be waiting too much on those pullbacks, or you don't want to be relying too much on the pullbacks. It makes more sense to be looking to invest early in 2024 for the long term, as opposed to being too conservative at this stage. I do agree from an options perspective, you may want to wait a bit more for a pullback because timing is a little bit more important. All right, shifting our focus to the Nasdaq, we are seeing the Nasdaq now pretty much at all-time high territory at 408. Price currently sitting at just shy of 408. So again, a lot of underlying momentum here for the Nasdaq 100. We are seeing a rotation back into technology, which we will discuss further later on. And this bodes well for some outperformance for the Nasdaq relative to the S&P 500. Other than that, there isn't really too much to discuss. Both the charts are quite similar. If we do get a eventual breakout before the end of the year, maybe wait for that pullback, a slight pullback to retest the 408 level before continuation higher. Now, IWM, we're looking at small caps here with the Russell 2000 ETF, and this is where things get very interesting for me. So, small caps, let's take a look at the price action over the last few weeks. We saw a breakout above 188 last week. That was a very strong breakout because that 188 level is a 38.2 fib level. And there's a lot of underlying momentum that helped price reach the 200 area, where it is once again running into some resistance, which again, another key level for IWM, which is a pretty nice chart to trade because it's the key levels are very obvious. So we are running into some resistance at 200. However, price is showing very similar behavior to what it showed when price was below 188. A little bit of resistance, not exactly reversing lower, and set to open a good bit higher this morning as well. So I do expect this level to be broken sooner rather than later, and price continuing towards a 210 level, which is a 23.6 fib level. So what I find quite interesting about small caps is we are now finally seeing outperformance relative to large caps. For the last couple of years, we saw underperformance. Now we're seeing outperformance. And this last time that happened for an extended period of time was late 2020, as we were setting up for the 2021 bullish rally. So usually when small caps are outperforming large caps, what that tells us is that we are in store for really for a bull market over the next few months. And with 2024's interest rate cuts, it's looking like it does look like it's setting up to be a nice bull market here, especially with this additional confirmation of small cap outperformance. Unlike the large caps, small caps still have a very long way to go to reach that all-time high territory at 245. But its recent performance does suggest that we should be quite optimistic for 2024 with both small caps and large caps. So yeah, I do think we'll get this breakout sooner rather than later above 200, and we should be seeing 210 quite soon as well. So TLT, the Treasury Bond ETF, last couple of weeks, I have spoken about the fact that sentiment has shifted to a bearish one. We were constantly looking for selling opportunities, throughout the year, to a now a more bullish one because we've seen the bearish structure break. We've also seen a moving average crossover with the 21 exponential moving average crossing over the 55-day exponential moving average. Plenty of underlying momentum, as you can see with the 50-period CCI, and multiple levels broken to the upside. We did recently get a breakout and retest of 94 and an immediate continuation higher back towards that $100 major previous support level. Maybe could potentially act as some resistance. Let's see how that plays out. But when you look at the fundamentals with lower yields, bonds are naturally going to be moving higher. And TLT is no exception. So I do see a breakout here soon. The next key level is at 104. And what we saw last week was actually a pretty good way of how to trade TLT. Looking for minor pullbacks, like that one from 96 to 94. I don't think we'll get much steeper pullbacks than that because we are heading into a more dovish environment for next year. But those provide good buying opportunities for TLT, where the fundamentals clearly favor the upside. All right, moving on to the US dollar. So we saw with yields moving lower, the US dollar tends to move lower as well. Last week, price was at that 104 level, struggling to break above it, and has moved sharply lower, breaking below that 102.50 level. Previous swing support now turning out to be some resistance. And I wouldn't be surprised to see a continuation lower back towards 100, another support level. And then, of course, you have, 101 and then 100. Those are the two support levels that I see. 101 probably being the more minor level and that $100 level being the more major level to be looking out for. But the fundamentals do point to a bearish US dollar, and that will remain the case until I know the Japanese central bank, they are quite dovish with their interest rates, but the ECB as well as the Bank of England, a lot of the other major central banks, they need to start cutting interest rates to see the dollar outperform, because right now those countries that are still, I wouldn't say hawkish, but staying a bit more neutral, those currencies will be outperforming the US dollar in the short term. Now, gold is showing some very interesting price action. Last week, we saw that pull back, a strong rejection from 192. However, price actually came to this 184 level and a 55-day exponential moving average immediately finding support, especially after that Fed meeting last week. So there's still a lot of momentum in gold, but it is starting to consolidate below this 190 area, definitely showing signs of that. Now, a weaker dollar would indicate that there's a bit of a tailwind for gold. However, we are also in a risk-on environment where investors are naturally going to rotate out of safe havens like gold. So there is a bit of ambiguity with regards to gold, but prices are still remaining elevated on a weaker dollar. So I do expect this consolidation to continue. The breakout above 192, lower probability of that happening, even if the US dollar does continue to decline, because this is actually a major multi-year resistance level. Okay, light crude oil futures. We saw that there has been a strong decline from the 94 level, and price, it's pretty much been going in one direction all the way back down to our area that we discussed at around between 65 and 70, finding support at 68, and actually managing to push higher, however, not with a lot of momentum. So it's not a very convincing move higher to the upside. We saw an intraday rejection of 74 yesterday, and just the lack of momentum speaks to the fact that we could see more consolidation as opposed a full-on reversal higher for oil. And during a time where equities are moving higher, but oil is staying stagnant, that means that energy stocks that have a high correlation to oil prices are naturally going to be underperforming the broader market. And we'll see that on our next slide with the sector rotational chart, where we have 9 sectors in the improving and leading categories, 2 in the lagging and weakening. But the energy sector was in the improving category, looking, okay, I would say in the short term. However, it has lost a lot of momentum, heading slowly towards that lagging category. It's during a time where equities across the board are continuing to rally. In the improving category as well, we have staples, utilities, and healthcare, with 3 defensive sectors, all showing a loss in momentum. Again, risk on environment, that is going to be the case as investors rotate from these sectors into other sectors like technology and communications. 2 sectors, cyclical sectors, you could call them, that definitely perform very well in risk on environments. There was a limited pullback away from those sectors, which is why they are in a lagging and weakening categories. However, they are now seeing an improvement in terms of momentum, indicating that investors are rotating back into these sectors. And given last week's announcement, that makes sense. A more dovish environment is clearly going to help technology and communications. So I don't think it'll be too long before we see these 2 in the improving and leading categories. Elsewhere in the leading sectors, we have real estate underperforming, but it was providing a lot of leadership. I wouldn't say it's bearish. When you see this chart, just because the sectors are moving lower and to the left, it doesn't automatically mean they're bearish. It just means they're underperforming the broader market. And a lot of these sectors that have been in the leading category have been for a few days and are now experiencing a bit of a pullback as investors slowly rotate into technology and communications that are heavy hitting sectors in the S&P 500. All right, subsectors of interest, DRIV, the Autonomous and Electric Vehicle ETF. Bit of a slow burner, this one, because we saw price breaking above that 21 and 55-day exponential moving average, and we've seen a moving average crossover. However, price was stuck below that 2350 level and has only now managed to find the momentum to break above that level and heading towards that 25 target price that we've had. Still not quite there. So, I think that we should still stay in this trade, not technically at an overbought condition, but definitely approaching that. But overall, DRIV, 25 is definitely the target for it. And there is still that momentum to take it there, in my opinion. So we'll have to wait and see over the next few days. The other subsector that we have been looking at this year, or the last few months really, has been the JETS ETF, airline ETF. We started looking at that because price declined to this double bottom level, providing a very good risk to reward at the time to the upside. This is on the weekly time frame as well, so there was plenty of upside opportunity, and this ETF has definitely performed very well. We saw it break above a few key levels, including its exponential moving averages, as well as a $17 level, and immediately already approaching that 1950 resistance zone, consolidating slightly over the last couple of days, but still by no means reversing lower. So a lot of underlying momentum here for the airline ETF, and there's a lot of potential upside for those of you that are looking for a longer term buying opportunity. This is a cheap ETF. We saw it decline quite aggressively during COVID and obviously during the bear market last year. And because of that, it provides a very good long-term risk to reward bullish entry point. Okay, BMY. So BMY was a bullish idea that we've had for 2 weeks, and it hasn't really been performing all that great. It is, technically speaking, in a profitable position, but it hasn't been moving that much higher. We can see prices still stuck between the 21 and the 55-day exponential moving average, which makes it, still underperforming the broader market. But the reason we got into it was because of a significant decline in a relatively short space of time, making it a little bit oversold. But the bounce that we're getting, even though it's probably lasted a lot longer than many of the other retracements higher, it's still not showing a lot of momentum. So I'm not going to say we should close this one. I'm going to keep it open for now. Let's see how this performs. But BMY does need to start outperforming. Otherwise, we'd have to be taking limited profits on this name. Zscaler has now broken above that 220 level. We got into this trade a couple of weeks ago when price was just below 200. And as you can see, a lot of underlying momentum there to break it above another key area. And honestly, looking like there's plenty of upside. However, on the weekly time frame, a little bit overbought. Maybe wait for a limited pullback. I can't imagine a pullback going deeper than that 200 level. And then, from there we have 260 on the cards, a previous area of support and resistance. So far, Zscaler performing very well for us. Allstate. Allstate was a bearish play. And, the reason we went into this one was because of the major resistance level at around 144, 145. Price did rally towards that area, but immediately reversed lower on, I think it was Thursday, which bodes quite well. Sorry, on Wednesday, which does bode quite well for this position. We suggested a credit spread for this. I don't want to be in this position for too long, given the fact that we are in a very bullish environment. It still makes sense to go for bearish plays and bearish trades in the short term, but you don't want to be overly exposed to the bearish side. So we'll see how this performs in the next couple of days. Hopefully it can continue to move lower. But if it stays consolidating at 138, I'd be looking to take profits quite soon. Okay, Meta, another bullish play that we've had. We saw this pullback here to the 55-day exponential moving average, which is why we wanted to gain that bullish exposure. And from 320, it has rallied to 345 in a few days. So performing quite well, but also approaching a major resistance zone at around the 345, 350 level. So we could see price start to stagnate a little bit there. Also, momentum on the daily time frame has actually been declining. So you don't want to be betting against the overall market. I think if the equities move higher as a whole, Meta should be moving higher as well. But it does indicate that there might be some underperformance and there might be other names within that sector to be looking at instead. But so far, Meta has performed quite well. I would honestly say this is at take profit level, unless you want to wait a couple of days to see a breakout of 350. Okay, the new idea I have for today is Zoom video communications. Kind of ironic because we are using Zoom right now. However, this is a bearish play. It's a bearish play because of the 74 resistance zone, multiple rejections of that level, as you can see in the last few days. And price has been trading at this level since March. It's been in its range-bound market since March with resistance at 74, support at 68. So this is a name that has been underperforming its sector, has been underperforming the markets. and showing bearish price action at a key resistance zone, it does make sense that the risk reward favors the downside. We may not see a full-on decline back down towards 60, but perhaps towards, that 66 level or so. Again, short-term bearish play as opposed to having long-term bearish exposure in Zoom, given the current market environment, makes sense. So this is more to balance the portfolio. Even during a bull market, you don't want to be overly exposed to the bullish side because one or two bad weeks or bearish weeks could, really ruin your account almost. So it's still good to be balanced in terms of bullish and bearish plays. It's just more stock selection becomes quite important at this stage. So yeah, with that, that is all I have for you today. Guys, thank you so much for joining me. And thank you so much for joining me throughout the year. I hope you've all had a great trading year. And yeah, I am looking forward to 2024 already. That being said, I hope you all have a great Christmas and festive season. And of course, have a great new year. And yep, I will see you in 2024. Goodbye, everyone.